Something critical has changed in the silver market, and it's not what most investors think. This rally is not being driven by retail buyers. It's not a social media squeeze, and it's not leverage-fueled speculation. According to Francis Hunt, that distinction matters, because markets behave very differently depending on who is doing the buying. When prices are driven by speculators, margin hikes kill momentum, liquidity dries up, and rallies collapse. But when prices are driven by physical demand, those same tools stop working. And that's one of the most important points Hunt makes in his recent interview with Capital COSM. This is not a retail bull market. This is a producer and industry-driven market where buyers don't consider themselves owners unless the metal is delivered and under their control. That changes everything. Because industrial users don't buy silver for price appreciation, they buy it because they must. And when supply tightens, they don't walk away, they bid higher. Hunt explains that this shift is happening at the same time confidence in fiat and debt is breaking down. Not slowly, structurally. In his words, fiat and debt are not separate systems. They are the same instrument, one promised tomorrow, one printed today. And as that debasement accelerates, precious metals stop behaving like trades and start behaving like insurance. Silver especially. Unlike gold, silver is consumed. It isn't endlessly recycled. And every new technology, batteries, electrification, energy storage, pulls more physical metal out of circulation permanently, which means silver faces something gold does not, a delivery problem, not just a monetary one. That combination, monetary debasement colliding with physical scarcity, is what Hunt says creates the conditions for an entirely different kind of bull market. One where paper mechanisms lose influence. One where suppression becomes unstable. And one where price begins responding to availability, not sentiment. In today's video, you'll hear directly from Francis Hunt as he breaks down why this silver move is fundamentally misunderstood, why margin increases may actually be adding pressure rather than relieving it, and why decades of suppression may be approaching a point where the system simply can't absorb it anymore. Before we go into it, I want to say this honestly. If you value discussions that focus on structure instead of noise, on why markets move, not just that they move, please support the channel by liking the video and subscribing. It helps keep these conversations alive at a time when serious analysis is becoming increasingly rare. And I'd really like to hear your perspective in the comments. Do you see silver primarily as an investment, or as protection against a system that's changing faster than most people realize? Your insight matters. Now, let's go to Francis Hunt.
People who buy stocks are a different group of people than industrialists that need silver. So where's the demand coming that's driving the silver price? This is not a retail silver squeeze the bankers thing. Retail is a small component of this, and they've done margin increases. And by the way, key point on that, margin increases have put more pressure, upward pressure on the price, not downward. And I'll explain that in a bit if you want me to drill further on it. But anyway, let's park that for now. So this is a producer, a desperate producer-driven, physical demand-based bull market. It's not a, hey, all the libertarian free us from the Fed guys are using leverage to squeeze the banks. The effect is the same, but it's not being driven by us. It's not being driven by anything apart from people don't consider themselves to own silver truly unless they've had it delivered and it's under their control. And there is a loss of confidence in the system. This is a confidence-based crisis and trust in the system. The fiat and the debt is debasement, one of the same, fiat and debt. They're not separate assets. One is fiat later and one is fiat today. And we're in a debasement cycle. And when I draw these silvers in that parabola, the debt debasement is in this parabola, and you end up, when you add the two lines, with gold that holds value. You add them two together. So the one parabola that is inverted is causing the other parabola that is normally ascendant. And that's where we are. And silver is the anti-fiat. We've used and coined the phrase. I don't. One or two people copied us once or twice, but I don't see it gaining any traction. But it's the best way of saying it. There's a fiat and there's an anti-fiat. People can do it with religion and have a Christ and an antichrist. I don't see why they can't do it. And I see it very much in the same spiritual kind of war, if you'll excuse the analogies and the topic drift into all sorts of other areas, but the anti-fiat are precious metals. Gold is the king anti-fiat, silver is the queen, but the queen actually gets consumed and has a physical delivery issue. Gold can be recycled, and there's a lot of it stored in bullion. So we're getting a turbo on top of a turbo. Gold is the turbo and the king of the turbo. Silver's the twin turbo because it's got the production shortage to the consumption. And every new tech that they want us in that is battery driven, all the reasons for making it more efficient, like the solid state battery, if you were to get a solid state battery, those do 900 Ks range for a car, by the way. If 20% of that take up was in that solid state battery, why would you want the old battery, which the solid state charges in 8 minutes, or gets to at least 80% charge, I think it is in 8 minutes. That's as long as you normally take to fill gas on an ICE engine. I don't like battery and I won't be doing it. I'll resist as long as I can, but that's a moot point. The health benefits and all the other stuff. But they want everyone in a battery car so they can remotely control you and call you in and track and trace you like they do with their phone. And that's going to take off. People are going to want 900K range, and they're going to want less of a depreciation cycle. Think the Porsche Taycan, very nicely finished, but you've got a 55,000 pound battery change after 4 years because the range each year reduces on use. So, you know, there's so many drivers. Silver's going to run. Your question was, why miners not so much yet? Because retail is wrecked in terms of investment. We're in a stagflationary environment. We're going to roll into a hyper-stag, the extremer version of it. You've been in a sustained recession in and out if it was truly covered with real statistics, not the fake employment and the fake inflation numbers that you'll be giving. You've been told that, you know, consumption was good. Well, that's in increased expenditure. Well, that's on the fact that the dollar buys you much less. If your grocery shopping cost you 5 years ago, you know, $350 for you and your girlfriend, and it now costs you $600, you are spending more. GDP has gone up. Well, that's a bad measure if you're not adjusting it fully for the inflationary effect. So we've said the grand lie of inflation. So your retail investor is wrecked. That's who's not being able to get in there on any grand scale. Then you have to think about the big guys and the institutions. Banks don't want to vote for Christmas. Turkeys don't vote for Christmas. The last thing they want to do is start buying silver until they've first covered all their shorts and got out. So they're trying to do that. That's what's happening. There's rumors about UBS. I'm sure you heard them as well. And the SMB saying you need to close out. And I don't think they can feasibly do it. But anyway, so institutions and banks and ETFs, where everybody's saving money. Everybody got crowded out of making their own decisions long time ago and bought ETFs. And because of technology being what it is, the technology ETFs were it. So everybody's historically got all their performance from Mag 7. And in fact, the indices often haven't gone up if you take out Mag 7. So what we actually have is a crowded out trade brought by computer buying because it's cheap, and overweighting into ever grander stocks. So we have mega trillion, 5 trillion market cap, individual stocks that are hopelessly overvalued. And we have silver miners that are grossly undervalued because everyone else is lazy and wants cheap entrance into the market and thinks what performed for the previous decade and the previous decade before that is going to continue to perform. And our point on 2020, why I said it's the most important call we ever made, is that the thing turned. Debt and fiat started to collapse. And in fact, the NASDAQ is not performing divided by gold, the only accepted true unit of account when you are in fast devaluing, I think always, but specifically and especially when you're in a fast devaluing fiat and debt debasement time. I was just looking at the US, the Japanese 2-year and the 10-year. They are parabolas up in the interest rates, which means the valuations are parabolas down. And they are a slave nation that will be buried with the Pharaoh king, the dollar, as is, I suspect, Korea as well. So we're looking at these fundamentals and saying, divided by a gold ounce, actually there's very few things going up, except silver miners, despite not really responding recently. They did well over 125% last year, some 130. So there were big movers in that. But is it in the interest of the cartel to normalize investment into silver mining? They don't want you to be rich. They want you in a Mag 7, paying for the surveillance state. When you buy and increase the market cap of the surveillance state equities, such as Facebook, Microsoft, etc., you give them cheap equity for which they can consume any rival products, anything else. You give them massive leverage, massive power, and of course, BlackRock controls them because everybody's used an ETF. That's what they want. They don't want mining companies and resource companies becoming the new bull market. They want the cheap currency that helps them build out the surveillance state that they want to drop over you, the grid, the prison grid that is coming.
What Francis is touching on here goes far beyond markets. Because when you strip it down, this isn't just about silver miners being ignored or undervalued. It's about where capital is being deliberately directed and where it's being kept away from. When money is funneled almost exclusively into massive technology platforms, those platforms gain more than profits. They gain influence. They gain data. They gain behavioral control. Cheap equity allows them to expand endlessly, absorbing competitors, shaping information flows, tracking movement, spending habits, and eventually identity itself. And this is where the conversation shifts from investing to infrastructure. A system built on surveillance doesn't function without compliance, and compliance becomes much easier when people are financially fragile. This is why concepts like universal basic income are never presented alongside real asset ownership. You're offered stability, but not sovereignty, support, but not independence. Because someone who owns productive assets, real metal, or hard value outside the system doesn't need permission to survive. And that's precisely what makes gold and silver so inconvenient. They exist outside digital control. They don't require platforms. They don't depend on algorithms, approval, or access rights. Let's get back to Hunt's interview.
So they've resisted and suppressed the market. They first, and the smaller market that they could hold down was the silver market. They're doing that. Now we've run out of delivery space. They have to let the silver price do some price discovery. But what you do is if you keep the resources down, you keep the interest, because America is stock traders. They're into their property values and even more, they're stock trading nation. So you don't want it. And they could actually keep structural shorts, various other things on individuals. In fact, First Majestic had a very high short number at one point on them, known short number. And it's intentionally ignore giving excess coverage. How many times do you turn on CNBC? I don't turn them on at all, really, but occasionally I look just to see what the lie is of the moment. And you actually see them talking about Heckler or First Majestic and the incredible reports. Have you seen Keith Neumeyer on Business Night? No, they bring you Zuckerberg, Nvidia, you get him 20 times in a year, at every conference and everything, and Gates and all of that. They've created who's cool. This is Hollywood. They choose the actors they're going to promote and who they pay, and they actually want to keep the ones that do damage to their cause out, that speak too much truth. And that's a club. And, the silver miners aren't in that club. But eventually, just like for silver and the suppression game, numbers talk and BS walks. And they're going to be turned into cash cows, hemorrhaging cash cows. And the less they hedge, in fact, the more the price is going to go up and the more profit they're going to make. And eventually you're going to have something that's going to be on such ridiculously low PEs that they're going to start running. And that point that will come, like everything, but everything takes time. And I think they've actively resisted adding coverage to the industry as a whole and the miners. And I think the ESG part of that, the ESG part prior to this collapse, very much worked to help take the knees out of mining and resources company. We were meant to see them as dirty old businesses, and they did a lot of damage, and that's going to be wound back. It depends what kind of run you have. So when you had sort of Wall Street silver chase, and it's all small retailers all taking leverage and buying and hitting the stack, what you have is a speculator with leverage-based boom. And the way you kill a speculator with leverage-based boom is your up margin requirements. So the main mover of the market is the speculator who's been given too much leverage or has managed to get access to any amount of leverage, and you make that leverage more expensive, less available, and much more capital down. You do those three things. It's the same as house prices. If you have to put more money down, the interest rates are going higher, which we're predicting, by the way, with the debt-based collapse. You can afford to pay less. You can't chase for that house, and prices come down because everybody else that's relying on a mortgage is in the same boat as you. That's how you cull and take the knees of a speculative with leverage, retail-driven market. Now you've got to ask, is this market that market? A retail speculator with leverage markets? No, you and I might be doing that, but we're the sideshow. We're ants. This is major industry physically demanded market. What's different about that, and what is the net effect of that? Well, what it happens is when you increase margin, the way the futures market work is the buyer has to put more margin down and might pay more interest for the lesser margin that he gets to run in and whale in. But the same applies to sellers who do sellers contracts. You might say, okay, but why is that a problem? That means they're less selling. No, the mines sell in the futures market, and it goes up by day, the cost as well. So the longer they're in, the more it costs them to hedge, and they sell forward production. So when you increase the costs of them forward selling their production, and by duration as well, they say, well, we'll hold off a little longer. We're saving some money by not forward selling, and the price in the market is pretty good, as you can imagine. So they then don't bring it as soon, and they don't do it for as long, and it reduces supply of producers, which is the miners, making available because you push their cost. Remember, they have an accountant and a treasury that will be looking at this and go, they made it more expensive for us to go there and sell it. And we sell it and we hold the contract until, for 3 months. Why don't we just wait till the last week? You've saved a bunch of money by doing that. You've saved a bunch of money. And they're the ones that bring big contracts. You and I might buy one contract which has 5 by 1,000 industrial bars. Most retail, not buying 1,000-ounce industrial bars, by the way, in the futures market. I have, but most retail, 10 ounces, 100 ounces, maybe you get 100 ounce, from Scottsdale, and it's a nice little brick. People aren't buying the ugliest sin industrial use model. So it's not retail that's actually pushing the futures price up. And if you make the cost higher, people will be more tight and delay offering that contract. So what actually happens is you're killing the offer stack. There's a bid stack. There's the midpoint where the trade is taking place and it's flickering along, a little bit up, a little bit down. And there's all the offer stacks. At that price, I'm happy to sell my forward production. Remember, markets are used not just for speculators. There's the commodity, the business interests, the operators. I'm trying to remember what the phrase is. I'm having a bit of a brain fart, but the industrials, the commercials, they call it, when you get the breakdown on retail, commercial, speculators, etc. The miners are the commercials. So they'll choose more selectively. And given the price market, they also don't need to rush. So why should they pay more to rush to do what for a long time, just to hit a rate when it's already deep in the money and possibly going deeper? They're in greed mode now, and they can hold off. So what it actually does is it reduces the offer stack. And then those that are squeezed and in a suppressed situation, think UBS, as if the story is true. We don't know. There's rumor, there's everything. We've always suspected certain banks are going to be hit, American ones, European ones. They now have to chase much higher to get a certain number of contracts closed. So they have to bid more aggressively. And that's why you're getting the parabola move. And you've got that 60-year of suppression all having to be made right very, very quickly. And you've gone and made it worse. You've poured fuel on the fire by making it expensive for suppliers. Remember, it's not being driven by retail guys with leverage. We're not it. It's being driven by lack of supply and real delivery. The markets have turned real delivery. Where you previously used to have low percentages of delivery and it was all speculate and cash market, you're now having 60% being marked for delivery. That changes the game. It makes it a real market, and that's when you start to get real prices.
When you zoom out and connect everything Francis Hunt is describing, a very clear picture begins to form. This is not just a battle between paper and physical, it's a battle between centralization and independence. The financial system that developed over the past 50 years wasn't built to create widespread ownership. It was built to create participation, access without control. Stocks instead of assets, ETFs instead of possession, digits instead of delivery. And as long as markets remained abstract, that model worked. But when inflation accelerates, debt compounds, and trust begins to erode, abstraction becomes dangerous. Because you can't eat digits, you can't deliver contracts, and you can't protect yourself with promises, that's where gold and silver re-enter the conversation, not as speculation, but as refusal. Refusal to be entirely dependent, refusal to be fully digitized, refusal to exist only as an entry in someone else's system. What Francis is warning about is not science fiction. A surveillance-based economy requires visibility. Visibility requires digital rails. And digital rails require that people have nowhere else to stand. When wealth exists only inside the system, compliance becomes automatic. But when people hold real assets, assets that cannot be frozen, diluted, or permissioned, that leverage weakens. That's why silver is so uncomfortable for the system. Because unlike gold, silver is both monetary and industrial. It disappears into consumption. It cannot be endlessly recycled. And once delivery dominates settlement, suppression becomes exponentially harder. That's why this moment feels different. Not because prices are rising, but because control mechanisms are straining. You're seeing it in delivery ratios. You're seeing it in rising premiums. You're seeing it in producers pulling back supply. You're seeing it in institutions quietly repositioning while the public is distracted. This is not about getting rich overnight. It's about staying anchored in a world that is becoming increasingly unstable, economically, politically, and technologically. Gold and silver don't promise returns. They promise optionality. The option to step outside the grid. The option to retain purchasing power. If discussions like this help you think more clearly about what's coming, not from fear, but from preparation, please support the channel by liking the video and subscribing. It genuinely helps keep these conversations alive in a space where they're rarely allowed to surface. And I'd really like to hear from you in the comments. Do you see gold and silver as insurance, or as a line in the sand against a system that's changing faster than most people realize? Your insight matters, your voice matters, and these conversations matter more now than ever.